We had a meeting with our fractional CFO, and I love meeting with this guy. Go through our numbers with us and tell us about next steps and strategically plan moves like hiring people, office space, parking costs, leasing, buying cars, all that kind of stuff for the business. Makes us feel totally under control. And I want to recap some of the stuff we talked about. Okay, the more we grow and the more conversations we have with colleagues and other companies, agency owners, there's a consistent theme of either wanting to sell, not wanting to sell. You know, for us, I think at this point, we're still deciding what we want to do. Our fractional CFO is basically of the mindset that, well, let's just get you in that position, because whether you want to sell or not, you still need your books in order so that if you want to have debt or take on equity, equity partner like venture capital, you're prepared to do that. So the company's growing really fast, and if we want to continue to grow at this exponential rate, we might need more money to do that. So, and continue to pay ourselves. You know, let's say we're all taking 10 grand. If we want to grow more, we might have to take 4 grand because we need 2 more employees. Do we want to do that or not? And one way around that, we'll continue to pay ourselves consistently and grow, is debt financing, which is taking a loan against the company. There's some pros and cons to that as a strategy, and he shared all of those with us. I mean, one of the real good things about it is that you keep your company, all the equity stays with us, right? If we take on a loan, it's just against the company. And that's really good. We maintain control of the company as well. All the decision making that goes along with it. There's no additional party that's involved in any way. You know, getting rates between 5 and 6% on money at 5 years is pretty good too. And if growth is really substantial, we could either pay that off or get a bigger loan or whatever it is to continue to scale. And it's just one fixed expense item per month that we have to manage, and that seems totally doable without losing any equity in the company that we're building, which is really cool. One of the downsides though is that we would have to personally guarantee the loan. That means the real estate that I own would be subject to foreclosure from this debtor. And that's a scary concept to think about. Now, obviously, the only way that that would happen was if we default on the loan and the business completely blows up and shuts down, right? That's not really that exciting in any capacity. We haven't specifically talked about whether we want to do it or not because we're not there. We're just talking about the ideas and where we want to go with vision for the company. But if I put my properties in like a trust for my kids or something like that, maybe I can remove it. I don't know, but it's not something that's that exciting for me. But I've done it in the past, you know, when I was running consumer goods. All the merchant processing companies that you talk to are definitely going to want you to fully personally guarantee everything, and they'll take every penny of yours if something ends up happening with reserves, or they get stiffed, or there's some sort of lawsuit. You're totally screwed anyway. So I've done it in the past a bunch. It doesn't really scare me that much because, you know, you just believe in yourself and nothing bad's going to happen and you're going to continue to grow. But it's very real. I have a friend up in northern San Diego, the company she was working for. The company did that. They took on debt and defaulted on it, and the company ended up closing. Guy lost his whole house. It's a very real thing to think about. Equity partners or venture capital, you know, whatever the right terminology is, there's the other option. The pro to that is getting a large amount of money quickly, and it's specifically for exponential growth very fast. So if we wanted to take our company to 100 employees, you know, in the next 18 months, that's going to be really good for venture capital. A company like Uber needing to grow really fast was a great case study for that, because without the capital, they would have lost market share and not have been as big as they could have been. So I don't know if that kind of exponential, serious exponential, really fast growth is totally right for us at this point. But one of the real benefits of taking capital onto that kind of thing is you don't have any personal liability. So if we couldn't get comfortable with our personal finances, or we couldn't qualify for debt financing, we could do this equity finance, this venture capital type of equity position financing, where we take money, give up equity, and are able to use that money to grow the company really fast without any personal liability, which is really cool. So it's a very serious option for us as we do grow, if we want to grow faster. Perhaps that's the second phase, right? We use some debt financing to get us to the next stage, hire the right number of employees, get the bigger office, grow our book. Now we're stable again. Maybe we take on equity and get an enormous chunk of cash, and we open an LA office or a San Francisco office, or, you know, whatever it is, or buy a creative agency or buy an SEO company, or whatever it is. Maybe it's something that's exponential and very fast for growth. So it's cool to just know about why you would do certain things and the pros and cons of it as we move forward and try to figure out what we want to do with this company that's growing so fast. We talked a lot about the finances of the company as we grow forward, and a little bit about organizing our P&L. There's a couple things that are off, which is pretty much standard for every company that has a bookkeeper that's not working full time, we're told. So that's really good. Generally, things look really good, but as we move forward, we need to make sure we have 2 to 3 months of cash on hand for the company, so that when we're running on an accrual basis, we can keep growing and keep running the company, but without worrying about cash reserves. Because we have no idea. I mean, should we just push it to the limits and keep whatever, $5,000 in the bank account and hire as many people as we can and run the business on cash flow until we realize profit? No, that's not the right way to do it. The right way to do it is to keep 3 months of reserves, 2 or 3 months of reserves, cash reserves, dry powder, so you are ready to incur any variable costs that come in and continue to pay salaries, hire people, and grow at your stable rate. So that was really good for us to know as well, because we weren't really sure if it was a full year or 18 months of reserves or 5 months of reserves or whatever it is. So it's good to have a benchmark. We've been running our company on a cash basis. Now, typically an agency is billed 30, 60, or bills 30 days and gets paid 30 or 60 or 90. Some people are late, right? And not everyone pays on time. So running the business on an accrual basis is a much better way to actually operate the finances of the business. We can predict throughout the average of the year, all the expenses get paid very consistently, or at least we can predict what it's going to be, what the revenue is going to be, and make decisions easier because we know how much cash is coming in. Versus a cash basis, which is, you're restricted greatly by how much money you actually have, and the decisions you make are based on what you have right now. Whereas that could slow us down, because if we get paid the money that we're owed at 90 days from now, we could have brought someone in because we knew we were going to realize those profits. So it could stunt our growth a little bit, and accrual accounting is going to be a much smoother way to operate the business long term. So we're switching to that. And then you can run an analysis on 13-week cash flow for a cash basis. So if the accounting's done on accrual and then you run a 13-week cash flow through this company online, I'll link out below, it'll tell you on a cash basis how much money you have and how much you can spend on certain things, help you make decisions 13 weeks out, which again is the 2 or 3 months that he was mentioning before. So it's really cool, some of these tools and strategies that these people are using. Our fractional CFO is going to take over our bookkeeping and invoicing, collections, bill paying, all that kind of stuff. So all we have to do is worry about the business and running the business and growing the business, which is the perfect situation, and feeling very good about it. He's a great partner and is a great meeting. We love talking about this kind of stuff. All right, my name is Bobby Dietz. Thanks for watching this video, hearing about my agency growing. Feel free to like and subscribe this video, and we will see you in the next one.